Alrighty guys, thanks for clicking on this week's video. Today we are going to go over the bear put spread. And as per usual, I'm just going to show you how to do it, and then afterwards explain the benefits of this, the downsides of this, pretty much everything about it. So let's just get right into it. Obviously I'm not a financial advisor. I'm just doing this for you or for Uber right now. Invest at your own risk, you know what I mean? So for this, you generally want to go further out because this time, unlike not most trading methods, but unlike certain trading styles, time decay is not on your side. It is working against you, all right? So I usually like to go like about a month and a half out, because at about 13 days is really when I want to start making some good old money. Well, 13 days before expiration, or 2 weeks. So the first thing you're going to want to do, you don't want to buy a call, you want to buy a put. You want to do this for stocks you think you're going to go down, all right? So what you do is you want to buy a really in-the-money put. The reason you do this is because you have a greater chance of winning. The further you go out, the less chance you have, obviously. So for this strategy, you do want to go in the money more so, just because time decay, again, is not your friend. So for this one, I don't know, you do this, you know what I mean? Average cost, so this will cost you about $340. I don't want to go into all the details, but you're basically saying, hey, you know what, I think Uber's gonna go below $35. We already know it is because it's at $32.89. That's why it's so in the money, and that's why it's a lot more beautiful than, you know, going out of the money in this, for this case, and I'll explain why later on in the upcoming performance. So next, after you buy a really in the money put, you want to sell, this is the best part, a not so in the money put, but still in the money. The reason you don't want to go way out of the money because you're like, oh, if it expires, you know, you get to keep that, is because you want this bad boy to keep going down. It'll really exemplify it if it's if you buy closer over here instead of like out of the money. So you're gonna want to sell in the money put. I generally like to go right around here. Okay, you'll do that, and of course you get debited. That's gonna be $220 debited to your account. That's basically how you do it on Robinhood. If you're wondering why I use Robinhood, I used to use E-Trade, but mostly just because everybody uses Robinhood, so that's pretty much why. So thanks for watching. I will explain everything else that you need to know, the main ideas, and the next segment to come. Thanks for watching. Alrighty, the bear put spread. Now let's talk about when you would want to do this, when you might not want to do this, what time you should do this, because yes, that does matter, and whether or not you should do it at all. So the first things first is you want to figure out the net debit, okay? And to figure that out, all you have to do is take the option you bought at, the price of it, minus the option you sold. So in our case, one was, we'll say 3.34, or sorry, not 3.34, 3.40, because it was 340, so it just makes it easier, and subtract it by 2.20, which gives you 120. 120 is now your net debit. To figure out your max loss on this, multiply that by 100, and that'll give you a max loss of $120. Now, you want to find your max profit as well, just to see if you even want to enter this trade. And I know I didn't enter the trade, it was after hours. Plus, too, I don't know if I probably was going to do it anyways. This is just for an example. So now to find the max profit, what you're going to want to do is take the spread, which is basically the difference in between the two strike prices of the option you bought and the option you sold. So take $35 minus $33, which gives you $2. You subtract that $2 by your net debit, which is 1.20, which gives you 0.8. So your max profit is $80 and your max loss is $120, which may seem bad, but the reason we do these ones so in the money is because time decay is not on your side. So for that, to make up for the fact that it's, well, not on your side, and remember, 90% of options expire worthless, so you might as well get the ones that are at least in the money so they don't expire worthless in our case, and do it that way. And now we want to find our break-even point, which is pretty easy. You basically just take the strike price of the option that you bought and you minus it from your net debit. So you're going to take $35 and you're going to subtract 1.20, which gives you $33.80. So now let's go over why you might want to do this, why you might not want to do this, and all the previous stuff that I said earlier. So obviously I've talked about how time decay is not on your side, so that really stinks. But generally I like to do these type of trades when earnings reports are coming around. And the reason being because we have all noticed that stocks, whenever their earnings report come out, they either send the stock up a decent amount or down a decent amount because they either hit their earnings report estimate or they didn't. Usually if they miss it, the stock will go down, and usually if they hit it, the stock will go up. That's why you might want to do this instead, because even though time's not on your side, volatility is on your side. Now obviously you do this for a stock that you want it to go down, and of course you can trade this however you want. You can go more closer to at the money, or God forbid even out of the money if you think it's going to go that low, and you can make a bigger profit potential, and it'll cost you less to get into this trade. But that's where you, the individual investor, make your own decisions. As I previously stated earlier, the reason we go so in the money is because time decay is working against us, so that way if we only need a little bit of a move to downward in order to get our max profit. If you're picking a stock that really isn't that volatile at all, I would not suggest doing this type of strategy on it. You're actually looking for a more volatile stock. And the reason we sell an option that's pretty much in the money or at least close to it is because if we're wrong and the stock goes the other way, you get a bigger premium for selling stocks that are in the money or at least really close to it. So it kind of like makes it so we don't lose as much money as possible, because you could lower it and you could have a more upside potential, but you also have a more downside potential too. So just remember they're inversely proportionate to each other to an extent. So just keep that in mind as well. So either way, I hope you guys enjoyed the video. Leave a comment in the comment section below about basically anything. I just love the feedback on whatever you have to say. So as always, thanks for watching. Remember to leave a like, comment, subscribe for more future content.